The accounting principles are classified into two, that is accounting concepts and accounting conventions. Measuring, analyzing and recording the information, you need to communicate this information for whom it is needed. It not only ascertain the results, but it also portray the financial position of the concern. Hello everyone, I am Meghana, Department of Commerce. We are in the first session of Unit 1, the topic of accounting. In today's session, we'll learn about the accounting basics, all the basics of accounts. The agenda of today's session is meaning and definition of accounting, objective, importance, types of accounting, golden rules of accounting, and finally the concepts and convention of accounting. These all are the agendas of today's session. Before going to accounting, we should know what is the meaning of account. An account is a summarized of business transaction. Summarized of business transaction related to person, firm, industry. To know the profit or loss. In simple word, accounting is a summarized of business transaction related to person, firm, industry to know the profit or loss. Simple, accounting is a summarized of business transaction. What is business transaction? Business transaction is transfer of ownership from one person to another person. It is business transaction which is related to person, firm, industry to know the profit or loss. When we need to record all the transaction as an account to know whether the company is earning profit or loss. If it is profit, how we can improve it? If it is loss, how we can overcome from the losses? To know this, the account is maintained. The process of maintaining this account is accounting. Accounting is process of identifying, measuring, recording, communicating the required information related to economic events of an organization to the interested user of such information. That means it is the process of identifying, measuring and recording and communicating. That means first you need to identify the economic events. Then you should measure and then you should record the entries. Then communicate the required information related to economic events of an organization to the interested user of such information. After you measuring, analyzing and recording the information, you need to communicate this information for whom it is needed. The accounting should communicate to the people who is needed. So, it is the process of identifying, measuring, recording and communicating the required information. American Institute of Certified Public Accountant, which defines accounting as the art of recording, classifying, summarizing in a significant manner and in terms of money transaction and events which are in part at least of a financial character and interpreting the results thereof. According to American Institute of Certified Public Accountant, which defines accounting as the art of recording. You need to record all the transaction in a systematic way. There is a process for recording all the transaction. It is art of recording, classifying. You need to classify the data between which are the monetary transaction and non-monetary transaction. In accounting, we record only the money transaction or money's worth. You should classify between the money and non-monetary value, summarizing in a significant manner. After you analyze and classify them, you should summarize what all are the transaction you have recorded, and it should be of monetary transaction or money's worth. You should classify. It's art of recording. You should record, classify and summarize the significant manner. Summarize in a significant manner, that is which is related to money. You should record only the monetary transaction and interpret the results thereof. After you recording, classifying and summarizing the data, you should interpret the results. That is, the company is gaining loss or suffering from gaining profit or suffering from losses. You should interpret the results, whether it is profit or loss. So, accounting helps to know the profit or loss of the business. And next, objective of accounting. The first objective is to keeping systematic records is important for every business. Every business, they need to maintain the records in a systematic way, because whenever they need the information, they can easily get it and they can take what the information they are needed easily. All the transaction has been recorded in a systematic way. It is easy for the users to get the information. It reduces the time for to search or to checking where is the information. If you maintain the record in a systematic way, according to the date, according to the chronological order, it is easy for the user to get the information. So, it helps to keeping systematic record to ascertain the results of operation. After you are recording all the transaction, it helps in ascertaining the results. That is, whether business is running in profit or they are suffering from losses. And it helps to ascertain what is the reason for the losses and how they can improve the profit. It helps to ascertain what is the reason for losses or what all the measures they can take to improve their profit. It ascertains the results of the operations. Next, to ascertain the financial position. It not only ascertain the results, but it also portray the financial position of the concern. How much cash they have in the business at present, and the amount of assets, what all are the assets they are having, and the liability they need to pay, what all are the liabilities, assets and cash. All the information it portrays. So, it decides the financial position of the business. By this, they can easily know what all are the assets they are having and the liabilities they need to pay. So, it helps in ascertaining financial position. Next, to portray the liquidity ratio, liquidity position. To portray the liquidity position, that means how they spend the cash in the business. All the information we can get it from the account. So, it helps to portray the liquidity position. Next one, to protect business property. If you are maintaining the account in a systematic way, we can get all the information in order wise, and the fact is they can easily find. Nobody can cheat if the accounts is maintained in a proper way. We have proof of that all the transaction which have made and the payment or receipts that have made. It helps to protect the business property so that nobody can cheat the business. So, next, to facilitate rational decision making. If you are having all the records and all the entries, it show company is running in profit or they are suffering from loss. It helps the decision maker to take quick decision. If it is necessary, they can take measures easily and they can make decision quickly. So, it helps in rational decision making. So, this is the objective of accounting. Next, importance of accounting to various users. For various users, it is important for maintaining the books of account. First one, to owners. To owners, it is important to maintain the accounts to know what all are the incomes they are earning. To know what all are the incomes the business is earning, so that they can know the income and expenses of business. And to management. To management, it helps to know the financial position. For management, it helps to know the financial position. It helps management to take necessary decision. Next, to creditors. It helps the creditors to decide the ability of repaying the debt of the business. By seeing the financial statement, the creditor can decide whether the company have the ability to repay its debt or not. By seeing this, they can decide to lend the loan or not. It helps creditors. To employees. To employees, it helps to know whether the company is able to increase the salary or not. And they can provide the employment for longer run or not. It helps the employees to verify the ability of business to increase the salary and employment. They can decide by seeing the financial statement. The company is in the position of increasing the salary or not, or they can decide their employment is in a longer run or in shorter run. Next, to investors. It helps the investors to know the financial position and the results and the profit or the losses. It helps the investors to decide whether to invest in the company or not. And if they invest in the company, how much the dividend they are getting, or how much, if the company is suffering from losses, they cannot expect the dividend. So, it helps the investor to make decision about their investment. Next, to government. To government, it helps to know if the company is supplying the goods at a reasonable price, as they are a local company. That means they are in the to government. It helps the government to know the company is supplying the goods at a reasonable price or not. It helps the government to know they are legally following the rules. That means they are supplying the goods at a reasonable price to the customer or not. To consumer. To consumer, it helps the consumer to know they are getting the efficient product at a reasonable price or not. It helps the customer to know about the product that they are supplying, and if the product is supplied, it is a longer run or a shorter run. It helps the customer to know that. To research scholars, it provides the information to the research scholars so that they can do their work. It helps the research scholars to make their research. So, these all are the important of accounting to various users. Next, bookkeeping. In simple word, bookkeeping is The process of recording all the transaction in a systematic way in a book. It is called bookkeeping. Bookkeeping includes recording of journals, posting in ledger and balancing of accounts. All the records before preparation of trial balance in the whole subject matter of bookkeeping. Bookkeeping is the science and art of correctly recording in the books of account all those business transactions that result in the transfer of money or money's worth. It is science as well as art of correctly recording in the books of account. It is the science as well as art of recording all the entries in a systematic way, and correctly it should be recorded in the books of accounts. You should record only the money transaction or money's worth. It should be recorded only money or money's worth. This is bookkeeping. Next, types of accounts and golden rules of accounting. Types of account, we have 3 types of accounts: personal account, real account and nominal account. Personal account includes a person, individual person, firm, industry or joint stock company. This all includes in a personal account. Real account includes all the assets and the liability of the business comes under real account. Nominal account. Nominal account includes all the expenses, losses and the gains and incomes. This all comes under the nominal account. Personal accounts, for example, you are purchasing goods for rupees 10,000. You are purchasing goods for rupees 10,000. That means your purchasing means you are receiving of some goods. That means your purchase. You need to debit the purchase and credit the giver. Who is giving or what is going out? That should be credited. If you are giving rupees 10,000, for example, you are giving rupees 10,000 to XYZ. M is giving rupees 10,000 to XYZ. Here the receiver is XYZ. Debit the receiver. You should debit the XYZ account. Credit the giver. Here giver is M. So you should credit the M. This is the rule for personal account. Real account. Real account means debit what comes in, credit what goes out. Real account is debit what comes in, credit what goes out. Here you will purchase goods for rupees 5,000. For example, you have purchased goods for rupees 5,000. Apply the real account rule. Debit what comes in. Debit what comes in. Here, the purchase, what you will purchase, the asset is coming in. So, you need to debit the purchase. Credit what goes out. Here, you are paying cash of rupees 5,000. Cash is going out. So, you need to credit cash. What is coming in, you need to debit that. And what is going out from the business, you need to credit that. Next, nominal account. Nominal account is debit all the expenses and losses, credit all the incomes and gains. For nominal account, it includes all the expenses and losses and incomes and gains. If you are earning any profit, any income, you need to credit that income. If you are paying any expenses or you are, for example, you are paying rent. You are paying rent means it is expense. So, you need to debit the expenses. For example, rent paid. Credit all the incomes. Income what you are receiving. For example, commission received. Commission received. Commission received is an income for the business. So, you need to credit the income. Personal account, debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. Nominal account, debit all the expenses and losses, credit all the incomes and gains. The next, accounting principles. According to American Institute of Certified Public Accountant, an accounting principle is a general law or rule adopted or preferred as a guide to action, a settled ground of business conducted or practice. According to American Institute of Certified Public Accountant, an accounting principle is general law or rule. It is a general law or rule which are adopted by a business. It acts as a guide for in decision making. It preferred as a guide to action, a settled ground of business conducted or practice. Many of the business, they adopt the principles while taking the decision. It acts as a guide. Generally accepted accounting principles. The name only says the accounting principles which are generally accepted by the accountant is called generally accepted accounting principles. In other words, generally accepted accounting principles are the set of guidelines and rules which are widely accepted by accounting practitioner. That means generally accepted accounting principles are set of guidelines or rules which are widely accepted by accounting practitioner. So, some accounting principles which are widely accepted by the accountant is called as generally accepted accounting principles. Accounting policies. Accounting policy are the specific accounting principles and the method of applying those principles that are considered by a business enterprises to be the most appropriate in preparing and presenting the financial statements. Accounting policies means specific accounting principle. Specific accounting principles and the method of applying those principles. We have several principles. In that, specific principles which is appropriate to their business in preparing and presenting their financial statements. It is more appropriate for their business. It helps in preparing their financial statements. Accounting policy is some specific accounting principles and method of applying those principles which is considered by a business. It is most appropriate for them for preparation of their financial accounting. So, it is accounting policies. The classification of accounting principles. The accounting principles are classified into two, that is accounting concepts and accounting conventions. First, accounting concepts. In accounting concepts, first one, money measurement concept. The name only says money measurement concept means record only the money value. In the books of account, you should record only the monetary value, that is, which can be expressed in terms of money or money's worth. For example, in business entity, your supervisor appreciate your teamwork. It is a business related transaction only, but it cannot be measured and expressed in terms of money. So, you cannot be recorded the appreciation by the supervisor. It cannot be expressed in terms of money. So, you cannot record this in a books of account because it will not affect on the financial position of the business. So, it cannot be taken as a economic event or monetary value. So, this concept says record only the monetary value or which are expressed in terms of money. Next, separate entity concept. Second one is separate entity concept. Separate entity concept says the proprietor of the business and the business is two separate entity. Even though the proprietor starts the business, it is differ from proprietor to business. You should maintain separate books of account. You should maintain separate books of account for both proprietor as well as the business. So, entries of proprietor will not affect on the business and the business transaction will not affect on the proprietor. Next, going concern concept. Going concern concept means prepare your record all the transaction and maintain the books of accounts keeping in the mind your business is going longer run. You should prepare your account as the business is going longer run and they are longer run business. So, you should prepare your accounts as it's a longer run. It continues for longer period. Next, cost concept. This concept says you are buying some assets. But you are buying some assets from outside. That is, you have purchased some assets for rupees 1 lakh, but its actual price in the market was 1,10,000. Its actual price is 1,10,000, but the cost at which you have purchased is 1 lakh. So, in this case, while recording the entries in the books of account, you should consider only the cost. Only the cost, not the market price. You should record at what price cost of acquisition will be considered as cost for recording the transaction. You should not consider the market value of the asset, and this cost value is basis for further calculation of this asset. Next, dual aspect concept. Dual aspect concept means when you are purchasing or any transaction is made, there is two persons. One is beneficiary of some value and another one is beneficiary of same value in the other form. That means two persons are benefited by their transaction, but one in different form and another one in different form. For example, you are purchasing goods for cash. So, you are benefited by the goods and other person is benefited equal value of cash. So, both are benefited, but one is benefited in the form of cash and another one is benefited in the form of goods or asset. So, both the benefited person, it should be recorded. One should be a receiver and one should be a giver. That is, one should be debited and one should be credited. So, both the debit and credit should be recorded. Both the debit and credit should be recorded. This is about dual aspect concept. Accounting period concept. Next one, accounting period concept. Accounting period concept is analyzing or interpreting the results of financial performance by splitting the business entity in a short period. That means to know the result, whether they are in profit or loss, you need to interpret the results. So for interpreting for the financial position, the business is splitted into small period. That is called accounting period. The whole year is splitted into convenient short period. So for example, split it for 3 months. For every 3 months, you will interpret the results and interpreting whether they can earn profit in future or not. It helps them to take necessary steps or important decision regarding their business transaction. So accounting period is knowing the results for splitting the business entity in a small convenient period for interpreting the result. Next one, objective evidence concept. Objective evidence concept means when you entered all the transaction in a books of account, it should be subject to evidence. That means you should have all the evidence of the transaction. That is invoice, bill, and it should be subject to verify by the auditor. Whenever the auditor is required or they may ask, you will provide all the bills and it should be verified by them. It is true or it should be maintained in proper way. So it acts as a evidence. So next one, revenue realization concept. Revenue realization concept means when the revenue is earned on the sale of goods or rendering the services, you are receiving some amounts in advance. But the goods has not been supplied or it not been transferred. Only after transferring the goods from one person to another person, then only the revenue is realized. Even though you have received the amount as an advance, it should not be considered as asset or revenue. It should be considered as liability. You are liable to pay some goods in future. After transferring of the goods from one person to another person, then only the customer is liable to pay the amount. They are legally liable to pay the amount. Then only the revenue is realized. Till that, it considered as liability and not as revenue. Next, accrual concept. It is similar with revenue realization concept. Accrual concept means if you have supplied some goods to some person. So, after transferring of goods from one person to another, he is legally liable to pay the amount. Then, it is considered as revenue is realized, that is accrued. Even though you have not received the amount, they may take some day or they may take some time to repay the amount, but you considered it as a revenue because the transfer of goods is done. So it is considered as revenue. Even he is liable to pay. So you should consider this revenue is realized, that is accrued. So this is about accrual concept. Next, last one, matching concept. Matching concept means in financial statement, in profit and loss account and in income and expenses account, in order to know the profit or loss of the business, you need to compare with the revenue and the expenses. All the revenue of the business should be compared with expenses of the business. It should be matched and the difference is considered as profit, either profit or loss. If the revenue exceeds the expenses, then it should be considered as profit. If the expenses exceed than the revenue, it is considered as losses. So, in order to consider the profit or loss, the revenue and the expenses should be matched. In order to consider profit or loss, revenue and expenses should be matched, and the result is considered as either profit or loss. This all about the accounting concepts. Next one, accounting convention. We have 4 accounting conventions. Convention of materiality, convention of conservatism, convention of consistency, and convention of full disclosure. First one, convention of materiality. In this convention, it says record detailed information whichever is needed. In every transaction, in whole transaction, record the detailed information only for specific transaction. That means whichever is needed, the detailed information, you should record the detailed information for specific records only, for specific entries. For other remaining entry, it can be a aerial view, or just you can only mention the account name like rent paid, commission. All this should they should need not to write all the detailed information. So only the transaction can be entered. But in some cases, you need to write detailed information. For example, investor or investment. In investment, you considered secured investments. In that, how much the method of calculating, this also should be mentioned. For example, you have purchased some pencil to the business. So, you have purchased some pencil to the business. You just entered, you have purchased pencil. By using this pencil every day, the value of this pencil will reduce from one day by day. You need not to record all the values which is reduced from day to day. Just you can mention only the purchase of pencil. There is no need for recording all the values which is reduced from day to day. In other cases, you need to record all the detailed information for the purpose of analysis. So, record only the detailed information which is necessary. Next, convention of conservatism. Convention of conservatism means consider only the losses and ignore the profit. That means while you are analyzing your financial position, if there is any losses, if there is any chances of loss, you considered it act as a caution so that you can take measures or you can improve your business while taking necessary steps. And if it is profit, just ignore it. If it is loss, means you will consider it as a caution and take a necessary steps. And if it is profit, ignore it. This convention says consider losses and ignore profit. Next, convention of consistency. Convention of consistency means you should maintain consistency in maintaining your books of account. For example, person A scored the percentage in 2018 80%, in 1982%, in 2020 78%, and in 2021 it's 85. This is maintaining the consistency. Take another example. B is scoring in 2018 70%, in 2019 60%, in 2020 30%, in 2021 45%. Is this maintaining the consistency? No. 70%, 60, 30, 45, this is not a consistency. In a similar way, in business, you should maintain consistency in recording your transaction. For example, in business, at the time of beginning, you decide that you are following straight line method of depreciation. When you start calculating your depreciation on straight line method, you should follow the same method for the next year, but you should not change your method of depreciation. You should follow the same method for upcoming year also. If you have changed it to written down value method, there are several methods of calculating depreciation. Once you start calculating your depreciation on the basis of straight line method, then you should follow the same method. You should not change your method of depreciation from one year to another year. So, this convention says maintain consistency in your accounts, in preparation of your accounts. Next, convention of full disclosure. Convention of full disclosure means you should disclose all the information to the necessary user. That means in your financial statement, you should disclose all the information in detail. For example, take debtors. You have debtors of rupees 1 lakh. It is not sufficient information in your financial statement. In this debtor, you should mention how much percentage is good debtor. How much you have good debtors. That means which is this amount will be recovered. It is sure you can recover how much percentage, and how much is bad debts, and how much bad debts. That means you sell the goods on the basis of credit, and the person who is purchased, he became insolvent and is not able to repay your debt. It is considered as bad debt. You cannot recover this amount. So it should be mentioned how much is good debt and how much is bad debt, and you have doubtful debt. You have doubt about the debt, whether it may be recovered or not. This also should be mentioned in your financial statement, so that the investors will get to know how much the debtors we have in this, how much is good debtor and how much is bad and how much is doubtful debt. All the information can easily get to the investors as well as the who is needed the information. So, this convention say convention of full disclosure. You should disclose all the information which is needed for the investor as well as the accountant and who is needed. So, this all about the accounting convention. In today's session, we discussed about We discussed about meaning and definition of accounting and objective of accounting and the importance of accounting, types and golden rules of accounting, and the concepts and conventions of accounting. In the next session, we discuss about further topics of the subject. So, this all about today's session. Let us meet in the next session. Thank you.